Hello everybody, my name is Chris Previty. I'm a Director of Healthcare Services at Feeley Driscoll, CPA firm in Boston, Mass. Today we will be reviewing accounting and financial reporting basics. We will have an overview of financial statements, terminology, and financial ratios. If there are any questions at the end of the presentation, please give us a call at 617-742-7788 or visit us at www.fdcpa.com. Today I will be going over financial statement basics, engagement types. We'll briefly discuss for-profit and not-for-profit differences in financial statements and reporting, and we'll review financial statement opinions on these types of engagements. Secondly, we will review main schedules in an annual audited financial statement. We will review balance sheet, income statement, cash flows, changes in net assets, and schedules of expenses. We will briefly discuss the footnotes to the financial statements. And lastly, we will review some key financial indicators that organizations should be aware of when performing their monthly accounting. Different engagement types include an audit of a financial statement, a review of a financial statement, or a compilation. A compilation requires the least amount of assurance over an entity's financial performance. We as auditors would perform no work in regards to a compilation where we would just receive the information from an organization, compile that information into a financial statement format, and present that. In a compilation, there is no auditing, no testing, no vouching, or no analytical review. The most significant engagement in which an auditor would perform would be an audit. In an audit, an auditor will perform confirmations, test accounts, recalculate. An auditor would inquire of management and perform analytical review over financial statements and account balances. An audit provides the third party the most assurance in regards to the financial position of an organization. A reviewed set of financial statements would provide less assurance than an audit and requires no testing. An auditor would review account detail, inquire of management, and perform analytical review only in a review set of financial statements. Now, depending on the third party or the need to have a financial statement complete would be the determining factor in regards to whether an audit, a review, or a compilation is required for a particular organization. Typically, the larger the organization, the higher the need for outside financing, or the larger the need for investor funds would be the main driver in the need for an audit. Some banks or some third-party providers may not require that much assurance over financial statements, in which case they would require an organization to obtain a review. Some financial statement schedules that we will review today would be the balance sheet, the income statement or profit and loss schedule, statement of changes in stockholders' equity, a statement of cash flows, statement of cost of goods sold, a statement of selling, general, and administrative expenses, and then also the notes to the financial statements. Typically, financial statements are presented on a comparable basis. However, this is not a requirement by generally accepted accounting principles, and in most instances would be a preference of the reader of the financial statements or of management. A not-for-profit financial statement is very similar to a for-profit set of financial statements. Some of the schedules in a not-for-profit financial statement are similar, however the titles are just different. A balance sheet on a for-profit set of financial statements would be known as a statement of financial position on a not-for-profit. An income statement or profit and loss on a for-profit entity would be considered a statement of activities. A statement of changes is consistent from one type of organization to the next. However, again, the terminology may be different. You may see a statement of stockholders' equity on a for-profit schedule and a statement of changes in net assets on a non-profit. Your statement of cash flows will typically always be named the same, and your schedules of expenses would also differ from for-profit to non-for-profit reporting. In a for-profit, you will see a schedule of cost of goods sold and selling, general, and administrative expenses, whereas in a not-for-profit, you'll see a schedule of functional expenses. At the end of the day, both sets of expenses will present the expenses on a natural classification that essentially just get rolled up into either a functional category or a general administrative category for a for-profit. When reading financial statement opinions in a set of financial statements, there are three key points to note in both an audited opinion and a reviewed opinion. An audit opinion will first explain management's responsibility to the financial statements. Management's responsibility is to provide the information to the auditor that is in accordance with GAAP. Our responsibility as auditors is to express an opinion on the financial statements based on the audits that we perform. We as auditors are not required to prepare the financial statements. This is the responsibility of management. We as auditors do not test internal control as part of our audit. However, we do consider internal control for designing the audit tests and procedures that we perform during the audit. It is necessary that we review internal controls and perform limited tests so that we as auditors can have reasonable assurance and that we can rely on the substantive procedures that we will perform as part of the audit. We do not opine over internal controls in a financial statement audit. Lastly, we will express an opinion on the audit based on our results. Our opinion over the financial statements will typically be unqualified if there are no material misstatements noted during the testing of our audit. A review financial statement opinion is worded significantly different than an audited opinion. A review includes applying analytical procedures to management's data and making inquiries only of company management. Nowhere in the opinion does it discuss performing audit tests or mention internal controls. The review opinion does state that a review is substantially less in scope than an audit. The review opinion also does discuss that management is responsible for the preparation and fair presentation of the financial statements in accordance with generally accepted accounting principles. This is similar wording to that you would see in an audit opinion. And our responsibility over review financial statements would be to issue an opinion, qualified or unqualified, and to conduct our reviews in accordance with the Statements of Standards for Accounting and Review Services issued by the AICPA. Now I'll go through some examples of course schedules in a financial statement, and we'll point out some key areas to focus on when reviewing a financial statement. First, we have here the assets section of a balance sheet. The assets section of a balance sheet is split up between current and non-current assets. Current assets are those assets that are expected to be used or realized within the current operating cycle or the next 12 months. Here, in the example provided, we have cash, investments, and contracts receivables. Contracts receivables is a less liquid asset than cash or investments. These are amounts that we expect to collect in the near future. In this example provided, total current assets is $2.7 million. What this tells the reader of a financial statement is that over the next 12 months, we expect to use or collect $2.7 million of the organization's assets. When we get into financial ratios later in the presentation, we will see the importance of total current assets as a percentage of total current liabilities. In the mezzanine section, below current assets, is property and equipment. Property and equipment is considered a long-term asset and are those assets that are capitalized based on an organization's capitalization policy. In the example provided, motor vehicles, equipment, and tools have been purchased over time at cost of $930,000. Over their lifespan, they have depreciated $495,000, leaving a net book value of those assets of $434,000. The depreciation is determined based on the estimated useful life of the related asset. Finally, in the other assets section on the bottom of the page are long-term assets. Long-term assets may consist of a number of items and are not limited to those items presented here on this example. The balance sheet, second page, consists of liabilities and equity of the organization. Liabilities are split up between current and non-current liabilities. Current liabilities are those liabilities that are expected to be paid out within the current operating cycle over the next 12 months. Current liabilities may consist of items such as a no payable line of credit, which is due on demand and typically owed to a bank. Some organizations may carry debt. The majority of the debt is considered long-term, with the exception of the portion that is due within the next 12 months. Accounts payable, deferred revenue, and accrued expenses are just some other typical liability items you may see on a balance sheet. In the bottom section of the balance sheet is the stockholders' equity section. Stockholders' equity in a for-profit entity will consist of retained earnings, and occasionally you may see additional paid-in capital. Additional paid-in capital are contributions paid into the organization by owners at some point during the organization's existence. These are not loans or monies expected to be paid back. However, they are tracked in your stockholders' equity section of the balance sheet. Total equity in this example is $1 million, $12,888. Oftentimes, you may hear the term equity also referred to as net assets, net worth, or restricted net assets in a not-for-profit organization. Retained earnings or equity in a for-profit organization are those earnings that have been kept in the company over the course of time of a company's existence. As auditors, we follow some basic accounting principles when reviewing financial statements and completing our audits or reviews over organizations. Revenue principle is that revenue is earned when the sale is made. That's when revenue would be realized. Expense principle is that the expense occurs when the business uses the goods or receives services. These two principles encompass an item known as accrual accounting. Therefore, even though certain amounts have not been paid or certain bills have not been received, those amounts are still reported as revenue and payables and expenses on the income statement. The matching principle is a principle that discusses recognizing revenue when the related expense occurs. Cost principle, amounts quantified or measured using historical cost. We discussed on the balance sheet that property, plant, and equipment, or those long-term assets, those capital assets, are recorded at cost and then discounted or depreciated over the useful life of the asset. And objectivity is a principle that discusses that the objective, factual, and verifiable data should be used in the financial statements. The less subjectivity, the better. Here we have an example of a statement of income and retained earnings in a for-profit entity. We discussed that revenue is recognized when earned, not necessarily when collected. So in this example, the $12 million could represent billings sent out to clients, however not necessarily collected. It does appear in this example that these financial statements relate to contract revenue, in which case there may be a separate recognition of the revenue for certain contracts. Cost of revenue earned is presented directly below revenues earned to come up to a gross profit figure for the organization. Cost of revenues earned consists of those direct costs required to operate your business, as well as some indirect costs which may need to be applied through a burden rate. Under gross profit are selling, general, and administrative costs. These are your fixed costs of an organization, those costs that are required or necessary to operate whether or not there is revenue services being performed. Such costs may consist of rent for your facility, office supplies, utilities, and other services not directly related to your primary source of revenue. Key performance indicator on the income statement is your income from operations, which would be reported after selling, general, and administrative expenses. Under income from operations, we report other income or expense, which are not considered selling, general, administrative expenses or direct and indirect expenses. Interest expense on debt or other income, such as rebates, insurance recoveries, or other miscellaneous income not part of the organization's core source of revenue. After other income or expense is the main performance indicator of net income. Some organizations may choose to show the changes or statement of changes in net assets as a part of the schedule of income. as you see here, rather than report a separate schedule. Here is just a reconciliation of retained earnings from beginning of the year to the end of the year, which includes the net income less some distributions paid to stockholders. Here we have a statement of changes in net assets, which will be seen on a not-for-profit entity only. This statement of changes in net assets has fund accounting, which shows unrestricted or temp-restricted net assets. A for-profit entity would either show a separate statement of changes in net assets, as discussed on the previous slide, or would show its own statement of changes in net assets, which would encompass just those amounts reported on the bottom of the income statement on the previous slide. In a non-for-profit organization, a statement of changes in net assets is necessary to reconcile total net assets for fund accounting purposes. A statement of change in net assets in a non-for-profit would report all temporarily and permanently restricted net asset activity. In the example provided, there is no permanent restricted net asset activity. However, there is temporarily restricted net asset activity reported of $3,753 in the middle, $53 in the middle section there. Same concept as in a for-profit financial statement, where we reconcile any changes in net assets that do not run through normal operations of an organization. The next example is a schedule of cost of revenues. In a for-profit entity, when deriving at gross profit, we will review direct and indirect costs of the organization. Direct costs are those costs that fluctuate with volume. Indirect costs are those costs that do fluctuate with volume, however, cannot be directly attributed to a particular job in this instance. Fixed costs are $8,119,000, and indirect costs are $1,244,000 for a total cost of revenues earned of $9,003,000, which ties onto your income statement. Typically, you'll see in a financial statement your schedule of selling general administrative expenses, sometimes also referred to as SG&A. SG&A expenses are typically those expenses, as I mentioned, that are not directly tied to volume fluctuations. Professional fees, advertising, marketing, office expenses are just some of the items that you would typically see in a selling general administrative schedule. As noted here, this is just an example. An owner's salary or officer's salary is not always broken out on a financial statement. In most instances, it is preference of management or recommendation by accountant. What we have here is a statement of functional expenses. The statement of functional expenses is a not-for-profit version of a schedule of selling general administrative or schedule of cost of revenues earned. Not-for-profit organizations report expenses on a functional basis because it is important for donors to understand, when donating money to a nonprofit, how that particular organization may be spending its funds. Typically, the more money spent for program purposes, the better. Here you will see the natural classification of expenses on the left-hand side, with the functional allocation going across the right. In this example, $1.378 million is spent on program expenses, while management in general, or administrative in general, is $404,000. Non-for-profit organizations are also required to break out fundraising expenses, which you see here in this third column. Those are the core schedules that you'd see on a financial statement on a both for-profit and not-for-profit entity. A cash flow statement is going to be very similar or identical in both a for-profit and not-for-profit financial statement. There are two methods in reporting cash flows: a direct method and an indirect method. Most common, we see the indirect method of the cash flow used in financial statements. The indirect method begins with net income, shows you changes in assets and liabilities, adds back non-cash items, and breaks out investing, operating, and financing activities. The direct method does not start with net income and shows the cash paid directly to the suppliers and received directly from the customers, and there's a separate reconciliation for operating cash. Investing and financing activities are reported similar in both methods. Some basic terminology that you'd see in the cash flow, as I had just mentioned: operating cash, investing cash, and financing activities. The primary objective of the cash flow is to provide relative information about cash receipts and disbursements of a particular entity during a period. We will review an example of a cash flow in the next slide. Operating activities is the key indicator in any cash flow statement. This amount represents the amount of cash generated by an entity's operating activities. An organization may have an increase in cash in a given year. However, that increase may have been derived by drawdown on a line of credit, or take out other outstanding debt, or cash out of investments. In order to get a complete understanding and see the full picture of what changed cash position in a given year, the cash flow statement is the place to go. Operating activities are amounts that result from an entity's normal operations for delivering or producing goods, for the sale or providing services. Investing activities, lending money and collecting loans, acquiring or selling disposable or disposing of available for sale or held to maturity securities or investments, or acquiring and selling other capital assets of the organization. Financing activities is when an organization would obtain resources from owners or investors or banks, and those items would be reported in the bottom section of a cash flow. If we look at a cash flow statement, we can see cash flow from operating activities as its top line. You start with net income and back out any non-cash items such as depreciation. To come to your total cash provided by operating activities, you show your changes in your assets and liabilities, growth or decrease in accounts payable or accounts receivable would be reported here as well. In this example provided, the organization generated $318,000 of positive operating cash. With that cash, there was $135,000 used in investing activities in the middle section. The organization purchased additional capital assets to be used for the organization. There was negative cash from financing activities as well of $429,000. There was a pay down on the line of credit of $200,000, as well as distributions made to the stockholder of $205,000. Those three subtitles, cash provided by operating, investing, and financing, encompass the total change in your cash. This particular organization had cash at the beginning of the year of $1.499. Cash decreased $245,000 to come to your cash figure at the end of the year. This is a good example of how an organization can generate positive net income and still have a decrease in its cash position in the current year. Any reader to the financial statements can come directly to the schedule to see where the money was spent to determine if the organization is generating cash from operating activities or not. Here, we have some sample footnotes to the financial statements. In general, most footnote 1 will disclose an organization's operations and sources of revenue and have a brief description of what the organization does. Footnote 2 would typically be your significant accounting policies, or in this particular example, it's footnote 2. This may also be located in footnote 1. However, any organization has accounting policies established during the year. If the reader of a financial statement would like to know how a particular item is reported in the financial statements, footnote 2 is where you would come to get that understanding. Next, we move on to the core footnotes of a financial statement, which starts with cash and cash equivalents. Now, the financial statement footnotes, aside from note 1 and 2, would all depend on what amounts are reported in the core schedules to the financial statements. Typically, any item reported on your balance sheet would be disclosed further in the footnotes to the financial statements. The footnotes act as a place for a reader to be able to go to get a better understanding of how a figure was derived at, what its composition is, and when it is expected to be paid back. In certain instances, we report where there are contingencies or other concentrations that are required to be disclosed in the footnotes. Note 3 in this example discusses FDIC disclosure in the company's current cash position. This footnote is to inform the reader that an organization may have a potential credit risk of the cash it has in the bank that exceeds current bank coverage. Also, a standard note you would see in a financial statement is the fair value measurement. This footnote is required to disclose an organization's policy for investments. The organization explains the policy in the footnote and discloses the composition of its investment portfolio over the course of two pages. The next slide, just two more examples of some footnotes that you would typically see in a financial statement, explaining or describing some of the assets or items in the income statement on a company's financial statement. That first footnote explains the line of credit, spells out the term, the maximum amount available, and the interest rate. The second note discusses any lease commitments that an organization may have in future periods. Overall, financial statements consist of core schedules and footnotes, which is to be used as a tool by investors, by third parties, whether it be banks or any other third party, or for management purposes, to get a better understanding of the financial position of a particular organization and where the organization is going in the future. Another way to get an understanding of how a company is doing is to review financial indicators, as indicated on this next slide. Some key financial indicators that we look at are the current ratio, working capital, days in AR, how many days does it take to collect our outstanding accounts receivable, average payment period, how many days does it take us to pay our typical debt, and days cash on hand. These ratios are known as liquidity ratios. The next set of ratios listed here is capital structure, where we look at equity financing, total debt to equity, cash flow to debt ratio, a debt service coverage, and an average age of plant. We'll review some of these ratios in the next few slides. And lastly, we review profitability ratios such as operating margin, total margin, and expense ratios as a percentage of revenues. The current ratio, as I discussed earlier on when reviewing the balance sheet, measures your current assets against your current liabilities. This ratio tells the reader, or tells management, what the organization's ability to meet its short-term obligations would be. The higher this ratio, the better. A decline in this ratio may indicate an inability to sustain adequate margins without closing operations. Working capital is a variant of the current ratio, where you take current assets minus your current liabilities. This just identifies the dollar value of the excess assets over your liabilities. The higher that dollar value, the more likelihood an organization has the ability to meet its short-term debt. Days in accounts receivable. The calculation here, as seen in that middle column by formula, tells the reader, on average, how many days does it take to collect its outstanding AR. If an organization is a manufacturer or a contractor and has terms that invoices are due on demand or due within 30 days, then in a perfect world, this ratio would be 30 days. However, a lot of times, customers take longer to pay, in which would increase that ratio. Management would review this ratio to determine if there are any issues potential in its outstanding accounts receivable balances. The average payment period, also known as days in accounts payable, measures the average length of time an entity takes to pay its obligations. Naturally, as cash could be tight in an organization, this ratio would increase. Days cash on hand measures the number of days of average cash expenditures that an organization maintains on its balance sheet. Days cash on hand typically measures just operating cash that could be used for operating purposes. How many days would an organization be able to pay its current obligations without obtaining any more cash? This figure could range anywhere between 10 days and 100 days, depending on the amount of cash on hand. The higher the better in this ratio. Here we review capital structure indicators and the equity financing ratio. Total net assets divided by total assets. We also measure total debt divided by total assets in the next ratio. The top ratio, you look for a higher value as a positive indicator of a sound financial organization. Low value in a debt to equity or debt to net asset ratio indicates to creditors that an entity's ability to carry additional long-term debt may not be strong. Some additional capital structure indicators are cash flow to debt ratio, debt service coverage, and average age of plant. We'll look at the debt service coverage ratio in the middle, which measures the ability to pay both components of debt, interest, and principal. Declining debt service is a red flag, typically seen as a debt covenant default for financial institutions. What is an organization's ability to pay its current debt service with its current net cash, net income, which is also, you may hear the term EBITDA, which is earnings before depreciation and interest and amortization. Last, average age of plant, accumulated depreciation divided by depreciation expense, is just an indicator that shows whether or not an organization has been putting money into its current facilities or not. The older the average age of plant, the more likely a particular facility needs to be updated. Here we have some profitability indicators, operating margin, total margin, and lastly bad debt percentage. The operating and total margin are two margins that can be calculated on the face of the financial statements. Here you would look at your income statement or your profit and loss to determine how an organization is doing. Operating margin is total operating income divided by total operating revenue, and total margin is your net income after other income and expense divided by total operating revenue. Occasionally we will look at bad debt percentage as well as the total percentage of revenue. This helps an organization determine whether its outstanding receivables over time have been properly written off, or if an organization needs to do a better job of trying to collect some outstanding AR. In this podcast, we hope to get across some terminology and help readers of financial statements understand the basic course schedules and the intent of the footnotes, as well as help a reader of the financial statements better analyze the figures that are reported in the financial statements you may be looking at. Again, I'm Chris Brevity, Director of Healthcare Services at Feeley Driscoll. We can be reached at 617-742-7788. You can visit us at our website at www.fdcpa.com. If there are any questions at all, we'd be happy to help. Thank you.